Each year, many of your clients go on several journeys. Some take a trip to a place where it's hot and offers good value. Arizona, Florida, Mexico, or the Caribbean. Your investment clients receive their annual statements and go down the road of inquiry trying to figure out how they did and why. Then they get their tax slips for those same investments or go down another road of review and inquiry. Those two roads may join up to meet you because some clients and advisors cannot reconcile what their statements say and what they have to report on their income tax return. So join me today on a trip of discovery and clarification. This session explains the reporting and taxation of growth, income, and cash flow out of investment funds. Attendees will gain a clear understanding of the difference in reporting between segregated funds and mutual funds, both during the accumulation period and for payout plans. You'll also learn how they work in both individually owned and corporate-owned scenarios through the use of case studies. We address the question of the reporting of capital distributions, including a section on the capital dividend account, which may be used in corporate situations to distribute certain types of investment income. But I will be excluding company and shareholder taxation of passive income because that is a whole topic unto itself. So let's look at the differences between non-registered funds, specifically segregated funds and mutual funds. With segregated funds, income allocations are reflected in the value of the fund. Neither the number of units nor the value of the fund changes on income allocation. The income allocation is generally pro rata for a period of the year held. In other words, it's done at a time-weighted approach. And so the amount you'll have to declare or report is based on how long you actually held that fund during the year. A notable difference, and I'll say this several times during the presentation, between segregated funds and mutual funds is that capital gains and losses can be allocated to policyholders of segregated funds. Mutual fund trusts generally distribute income to unit holders on record at the time of distribution. Distributed income decreases unit value. Unit holders are typically allocated a full year's worth of income regardless of when the units were purchased. Segregated funds, as I mentioned earlier, generally take a time-weighted approach. Fund distributions result in actual units or cash being reflected in the account. The default is a reinvestment of distribution in more units, which maintains the fund value. But the account holder has the option to receive cash via electronic fund transfer or a check. Keep in mind that each distribution that's reinvested purchases additional units at their current net asset value. Those distributions may be taxable. And reinvested distributions will always contribute to the adjusted cost base of the investment. Redeemed units will always decrease the adjusted cost base of the investment, and redeemed units will create capital gains or capital losses to the account holder. They're not actually reported by the company when you're dealing with a mutual fund. When you're looking at fund level activity, and you're then looking at how income is reported, Canadian Treasury bills, bonds, mortgages, index futures generally generate interest, which is reported for Canadian residents on box 26. It is fully taxable at the investor's marginal tax rate. Canadian corporation shares can kick out dividends, and those dividends will trigger a dividend tax credit, which will show up in eligible box 51, and if they're ineligible dividends, which most public corporations won't issue, will show up in box 39. Foreign bonds and corporate shares are classified as foreign income. They're reported on box 25. They are fully taxable, and foreign taxes are deducted before the allocation is made to the client. When you're looking at a sale of an investment that's owned by a segregated fund by the manager, not by the client, but by the manager, that can trigger a capital gain or a loss. And it's reflected if it's a capital gain in box 21. If it's a capital loss, it gets reflected in box 37. And remember that 50% of those gains and losses are allocated to the unit holders, and again is taxed at their marginal tax rate. When the client surrenders or redeems units, there's a valuation calculation done at the time of redemption or surrender. Again, if it results in a capital gain, that would happen if a market value is greater than the adjusted cost base of the policy. It could trigger a capital loss if the market value is less than the adjusted cost base of the policy. And in situations where you're dealing with a segregated fund and there is a capital loss, the guaranteed top-up, if it kicks in, will be treated as a capital gain. That capital gain, of course, will offset the realized capital loss, so it is a net zero effect from an income tax perspective to the actual client. One of the lures of a segregated fund, and one of the reasons why clients like them and why advisors like to recommend them, is that by and large you've got simple reporting. The insurance company tracks the adjusted cost base for income tax purposes. The company also calculates the capital gain or loss on redemption and reports them on a T3 slip. The client then simply includes those amounts in the appropriate boxes on their income tax return. A guaranteed top-up, as I mentioned earlier, is reported as a capital gain, so it offsets the reported capital loss, so there's a net zero impact to the client. A T3 slip never includes unrealized income, and one of the areas of confusion, of course, is that a client will receive a statement saying my statement says that my investment went way up in value, but it's not reflected on my tax slip. In fact, the converse sometimes happens as well. Their fund value goes up, but they may need to declare a capital loss of some kind, and therein lies the confusion, which I hope to clear up today. Now, there are several technical interpretations that have been published by the Canada Revenue Agency that support the industry practice to treat guaranteed top-ups for segregated funds as capital gains. But the industry still is waiting for the Department of Finance to clarify and codify the treatment as part of a legislative review that deal with segregated funds. Here's a little bit more about the transparent reporting of segregated funds. Again, segregated funds, unlike mutual funds, allocate capital losses, which can be used by the investor to offset gains from any other source. They can be used to offset gains that the client incurs in the current year, in the previous 3 years, or can be carried forward indefinitely. So really, the investor has control over when to use those capital losses. The taxable income is not related to changes in market value, and that's one of the fundamentals that investors and advisors need to understand. Taxable income is not related to changes in the market value. The T3 slip reports the client's share of allocated income or realized income of the fund, plus any realized capital or gain or loss from either the redemption or surrender of units. And the change in fund value over the years simply represents the unrealized capital gain or loss because the market has gone either up or down. Let's look at a schematic here of a mutual fund distribution. A mutual fund that's being held for the long term. So the client's objective is simply to invest money in a mutual fund, and they're going to not even consider taking any income from that plan. So we'll call that a Series A fund, an accumulation fund. Well, that fund could generate interest, dividends, or realized capital gains. Realized capital gains either because the client decides to make a switch or the fund manager decides to sell a holding. Whether it's paid in cash to the client or whether it's automatically reinvested into more units, and the latter is generally the case, it is taxed in either case. When you're looking at a Series T fund distribution, you're considering a mutual fund that has a structure to generate income on a regular basis, to generate predictable income as a percentage of the net asset value of the fund. The distributions will include a return of capital to the owner, and those distributions are not taxed. However, the fund, just like the previous diagram, will earn interest. It will earn dividends. There may be some realized capital gains, and those will be taxed. And so the box on the left may not equal the box on the right. And that interest, dividends, and realized capital gains is generally reinvested back into the fund, automatically invested to buy more units. So we talked about the Series T mutual fund, which is a payout program that people would use typically during retirement. The return of capital, which generally results in the money you put in being the first money you came out, is not immediately taxable, so there are some tax-deferred benefits. But each monthly distribution, which represents initially a return of capital and isn't taxed, lowers the adjusted cost base of the contract. So the distribution may in fact be tax-free in the early years, but it will result in a larger capital gain when the investment is eventually sold or the adjusted cost base equals zero.
Now, Peter, before you go on, we have a question asking whether Empire Life has any tools an advisor can use with their clients to demonstrate how T-Series mutual funds work.
That's a great question, Jeff. And yes, a number of years ago when we came out with the Series T plan, recognizing that this was really a product that was designed to support advisors in making recommendations to clients looking at generating income from their assets, we did design a tool, a Series T calculator that you can find on the site that's available to all advisors that actually will calculate Series T distribution. So you would input the amount of money you've actually got. It will calculate how much money you get out and how much of that will be taxable, and in fact goes 2 steps further. It will compare that to a systematic withdrawal plan and a GIC. So the comparison will not only show you table comparisons of those 3 types of investments, but also graphically show it to you so you can see at a very, very quick glance which one is better than the others and how long that advantage may last. Does that answer your question?
It does. Thank you very much, Peter.
Okay. So let's look at that Series T mutual fund. And initially at point number 1, the value represents the original adjusted cost base. And in this particular example, it's $1,000. Over a period of time, the same percentage of that original value goes down. And in this diagram, as you'll notice, the value seems to stay the same. So what's that telling you? Essentially, the amount of money you're taking out is equivalent over the long term to the growth in the actual contract. So at the end of that period of time, where that adjusted cost base is 0, the value of that fund is still exactly the same. But it does mean that all of that money that's still sitting in the contract will be a capital gain, would be equal to, in this particular example, $1,000. So it represents the market value minus the current adjusted cost base. That would be taxed as a capital gain, or it could be capital loss if the value is actually dropped. So let's look at an example of a schematic again of how that works. So your initial investment will actually represent the adjusted cost base of the contract, and every time you put money into a contract, it increases the adjusted cost base. When earnings are generated from that contract, including realized capital gains, and they're automatically put back in the contract for trust structures, mutual fund structures, it increases the adjusted cost base. When you redeem units, you're actually taking money out of the contract, that actually reduces the adjusted cost base. And when you compare a mutual fund trust structure to the traditional corporate structure, even though they were invested exactly the same way, and they would both have appear to have the same type of returns, the adjusted cost base typically wouldn't increase as much with a corporate structure because the client has the opportunity, if the client is making those switches, to actually defer the capital gain. And when you're deferring the capital gain, there's no realized gains that can be reported on a tax slip, and that adjusted cost base doesn't go up. Again, that changed last year. So in the budget of 2016, the regulations were changed where that no longer happens. If the client actually decides to make a switch, then of course that money, any gains that will be triggered at that point in time and will actually be reported. Now, here's another issue of confusion that exists with advisors when they're looking at mutual funds and they're looking at the different types of payouts. One of the payouts that can come out of a mutual fund is called especially from a mutual fund corporation, is called a capital gains dividend. So some people think, oh, that's capital gains dividend. That means the dividend is being treated as a capital gain. No, that's not what's happening at all. A mutual fund corporation pays federal refundable tax on any capital gains that are not distributed to the unit holders. And that refundable tax is tracked in a notional refundable capital gains tax on hand account. And the mutual fund corporation gets that tax back when it pays out those capital gains dividends or redeems them. So it actually comes out as a dividend and is taxed as a dividend. It just comes out of that notional account. Now, mutual fund corporations have some level of ongoing redemptions. The fund manager will retain capital gains in the corporation to offset, one, the capital gains refunds with respect to redemptions on money that's held back in previous years, or two, capital losses that have been carried forward from previous years, because again, a mutual fund corporation or a mutual fund trust cannot pass through capital losses. It has to hold those capital losses, and in the future year, when there's been some realized capital gains, it will wipe out internally the gains against the losses and pay out any net balance to the investors. A mutual fund trust distributes income as either dividends from taxable Canadian corporations, capital dividends, if applicable, taxable capital gains, foreign source income and related foreign tax, and other income including interest and royalties. And mutual fund trusts may also retain capital gains to offset capital gains refunds and accrued capital losses. Again, two taxable events can occur where either the unit holder redeems appreciated units, realizing a capital gain, or the fund manager disposes of some appreciated holdings to satisfy some redemptions, and that realizes a capital gain as well. In either one of those two situations, a tax slip will actually be triggered. Again, with a mutual fund, investors who buy units partway through the year may receive and pay tax on income realized in the fund before they join. And the cost of any pre-acquisition interest income that is part of the investor's cost base in the fund units factors in the capital gain or loss when they ultimately redeem those interests in those investments. So let's consider the impact of distributions on the adjusted cost base of a Series T mutual fund. In the initial period, the net asset value would be the same as the amount of money you put in that contract, and of course would also be the adjusted cost base. The cash flow in this particular example will be 6%, and typically when you're looking at a Series T mutual fund, you're looking at the general numbers are 6% or 8%, although some companies may have different percentages. So the cash flow would represent 6% of the net asset value. And after distributing 6% of the net asset value, or 6% of 100, the adjusted cost base at the end of the year would be $94. 5 periods later, let's say the net asset value equals $100. It's still the same thing. Well, what does that tell you? It means if your cash flow remains 6%, the fund has been earning on average about 6%. We'll say for example purposes, the adjusted cost base now is $50. The client takes out 6% as a distribution, and adjusted cost base at the year end drops to $44. Let's look at what happens the following period in one of two scenarios. In scenario 1, the net asset value remains $100, which means the client is taking out 6%, but the fund's earning about 6%. The adjusted cost base at the end of the year would be $38. But what happens if the net asset value goes to $130 instead of $100? Well, what's happened? In that particular period, the client actually experienced a 13% growth in their contract, not 6, but 13. Remember that the Series T distribution is based on that net asset value, so that cash value, that cash distribution will be 6% of 130, which further drops the adjusted cost base to 36.2, not 38. So the more you take out of that contract on a percentage basis, the faster your adjusted cost base will drop. The better your returns are in relation to the amount you're actually distributing, the faster your adjusted cost base drops to 0. So what happens to the adjusted cost base if you're taking out a higher percentage versus a lower percentage of pre-tax cash flow? Well, based on what I just explained to you, the adjusted cost base will drop. What happens if you get involved in a more aggressive investment? You move from a bond holding to a more balanced fund, or you move from a balanced fund to a high equity component. What's the impact going to be in the adjusted cost base? Essentially none. The adjusted cost base, though, will be impacted if you in fact have a higher return. Because if you have a higher return, you're taking out the same percentage of a much bigger number, which is going to be dropping that adjusted cost base. Now what happens if there's more distributions in terms of the percentage, which means there's more income being actually earned? Again, one of the things I really don't like about that number is that people actually aren't making a distribution of the taxable income. You're simply getting an allocation of that income. Your distributions are a return of capital, certainly in the early years. What's happening at the end of the year is you're being allocated your share of the realized interest, dividends, and capital gains and foreign dividends and income being earned in that particular fund. So that year-end allocation, if it gets higher, will positively impact the adjusted cost base because, as I said, those allocations represent the growth in the contract, the realized growth in the contract and the income. That income is automatically plowed back into the contract as if it was new money, and that, of course, will increase the adjusted cost base. And if you're in a higher tax rate, is there a difference? Is there going to be an impact to the adjusted cost base? The answer is no. Everybody got that? Because a lot of people do get this, do have some problems with some of these responses. Now, let's consider the impact on pre-tax cash flow of those same 5 factors. If you're to take out 8% instead of 6% before tax cash flow, what's the impact on your pre-tax cash flow? Well, naturally it goes up. If you have a more aggressive investment outlook, you invest in a much more aggressive fund, what's going to be the impact on your pre-tax cash flow? None. What if you generate a higher return? Again, keep in mind that the percentage that you're getting distributed is going to be 8% or 6% of that asset value. That's going to increase the pre-tax cash flow. More distributions, again, doesn't have an impact on the pre-tax cash flow. Those two things are run independently. And of course, your tax rate also does not have an impact on your pre-tax cash flow. And again, I don't like using the term distributions. Please make a note to yourselves and correct everyone else you see. The year-end allocation of income is what it should be called, not a year-end distribution of income, because you actually don't get the money. Now, what are the alternatives that the investor will have if, in fact, the adjusted cost base goes to zero in a Series T mutual fund? Well, they can continue the cash flow, and then they're going to get taxed on that cash flow, and of course, they're also going to get taxed on the realized earnings in the actual plan. They could alternatively switch from a Series T, which is a payout plan, to simply an accumulation plan. They can stop the cash flow. They can do that. In fact, with Empire, and with some other companies anyway, but I do that with Empire, you can stop and start that program. You could donate a portion of that money to charity, enough perhaps to cover the tax on the balance of the fund you held personally, so that you could take the rest of it out and not pay any more tax. You can get very, very magnanimous and donate the whole thing to charity by way of a change of ownership. One of the mistakes that some people make when they're donating investments to a charity is they cash in the investment and then they make the donation. When you do that, you can trigger all kinds of tax and before you actually make that donation. If you donate the shares as is, in other words, just take out a crayon, change the ownership from you to the your favorite cause, then the charity is responsible for actually cashing in the plan, surrendering it, holding on to it, and paying the tax, and you get a tax receipt for the gross value of the actual donation. And finally, of course, you can cash out the plan, paying capital gains tax on the unrealized capital gains. Remember, of course, that only 50% of the gain is taxable at your marginal tax rate. The rest of it, of course, can be paid out to you tax-free. Now let's look at income and distribution reporting on a Series T mutual fund. In this particular example, we have an individual who invested $100,000 into that type of a plan. They've actually earned $1,000 of interest, $2,000 of eligible dividends, and $2,500 of realized capital gains, either because the fund manager sold some holdings in the fund or the client decided to make some type of a switch. So there's going to be taxable reporting of $5,500. At the same time, the investor's saying, look, this is a Series T mutual fund. I'm 68 years old. I need to generate a regular income from that $100,000 investment, regardless of what's actually being earned in the fund. And so I could elect to either take out 6% of the $100,000 or 8%. So either $6,000 or $8,000 would represent a return of capital. This is what the tax slip would actually look like. The $1,000 of interest would show up under other income. The $2,000 would be the eligible dividends. The calculation would automatically affect the gross up of the dividends. The dividend tax credit would also be reported on that T3 slip, as would be the capital gains of $2,500. In addition, because you're dealing with a Series T mutual fund, there will be reporting of the $8,000 of monies that you're getting, which of course, as you remember, is a return of capital. It's up to you as the investor, you as the taxpayer, to keep track of that to figure out when your adjusted cost base goes to zero. Now, let's look at what happens with a guaranteed withdrawal benefit plan or segregated fund. If you had a $100,000 investment, saying $1,000 of interest earned, $2,000 of eligible dividends, $2,500 of realized capital gains, which again looks like $5,500 of tax reporting, and the client says, look, pay me out 4% of my money or pay me out 5% of my money. Well, what does that look like if you're not looking at a Series T mutual fund? It's going to look something like this. Your T3 slip will report the $1,000 of other income, will be interest income. It'll report the $2,000 of dividends. The dividend gross up will be calculated for you in your tax slip. Your dividend tax credit will show up in that slip as well. So it's just a matter of you or whoever prepares your tax returns to match those boxes wherever they report on your income tax return. And the capital gain shows up for $2,500. You notice, of course, that what doesn't show up in that particular slide, let me just go back a slide for a second, what doesn't show up is the actual distribution here. So when you're looking at a systematic withdrawal plan from a segregated fund or mutual fund, the actual distribution is not actually reflected on the tax slip. Now what happens if you're looking at a guaranteed withdrawal benefit segregated fund? In this particular situation, you've got that same $100,000 investment that's earned $1,000 of interest, it's earned $2,000 of eligible dividends, but there's actually been a $2,500 capital loss. So it's in brackets there because the realized capital gain really is a capital loss. So they're going to be tax reporting there of $3,000. And in this scenario, what's similar between the previous one is the cash flow remains at either 4% or 5%. So $4,000 or $5,000. The tax slip will reflect the $1,000 of interest. It will reflect the $2,000 of eligible dividends, plus the gross up for the dividend tax credit, reflected as $414. And the capital loss shows up in box 37. Again, we're talking about a segregated fund, and so it will actually report the $2,500 capital loss that the investor can use against some other capital gains either that year, will go back 3 years, or hold on for some future year. Let's look at some case study examples with segregated funds and how they actually operate from a reporting perspective. In case study 1, we're looking at the simple taxation of a guaranteed withdrawal benefit plan, where the client has made no switches. The Class 2.1 cash flow is achieved by redeeming or selling units. It operates like a systematic withdrawal plan, which is going to trigger some type of capital gain or loss. And we're going to assume that there's no fund income allocations in the year. In other words, the fund really didn't earn any interest. It didn't earn any dividends. It was maybe an equity account, or if there was any interest or dividends earned, they were eaten up by the management expense ratios, by the expenses needed to run the actual fund. And again, the client made no switches. It's simply a buy and hold strategy. In this example, we're looking at a $300,000 investment that appreciated in value 5%. So that client went down that road where they got that in their statement on that plan and said, oh, wow, I had $300,000 last year, and this year I made 5% of my money, got $315,000. But from that same plan, I was expecting to get $12,000 of income from that, or cash flow is probably a better way of phrasing it. Well, the realized capital gain is calculated using this particular formula. You look at the market value at the end of the year. You subtract from that the gain that was actually made and subtract that from that market value times the amount of money that comes out. So you're paying a proportionate share of capital gain on that $12,000, which, doing the math, works out to $571. That's what actually gets reported. Again, the tax proportion of that is 50%, which works out to $286. And the tax payable, assuming you're in a 30% tax bracket, works out to $86. So the client will receive cash flow payments of $12,000. At the end of the year, they'll have the tax slips, they'll file their tax returns, and they're going to end up paying about $86 in taxes. So the net cash flow to the client in this particular setup is going to be $11,914. And again, we're assuming this was all equity growth, and the unit holder made no trades or switches. In case study 2, we're looking at the same type of guaranteed withdrawal benefit plan, but there were some fund allocations made. So the fund allocates, as I said, earned income, whether that's interest or dividends or capital gains and losses proportionally by fund class. It pays them to all unit holders throughout the year, and again, it's reported to the unit holder at the end of the year. Again, that cash flow is achieved by redeeming or selling units. It operates very similarly to a systematic withdrawal plan. If the client makes a switch or withdrawal during the year, or if the client makes no switches and the fund manager sells an underlying security, that tax slip will reflect the realized capital gain or loss from the disposition or deemed disposition of that fund or of that undergreen holding. So keep that in mind. Once clients understand that, they just want a bit of an explanation as to, well, how much of that is being realized. Well, as you'll hear from the fund managers, when you listen to those fund manager calls, or you come out to our road shows, you listen to a fund manager, or you're talking to one of our investment managers, they'll periodically tell you that, you know, we decide to sell this particular holding and buy this holding or whatever. Well, those sales will trigger some type of a capital gain or loss, and that's going to be reflected on the tax slip. In this particular example, we've got that same $300,000 of investments. That's earned 5% on the money, so it's now worth $315,000. But there was an annual fund income allocation this year of $2,000 of eligible dividends plus $1,500 of capital gains. So the revised adjusted cost base is $303,500. We simply take the $300,000, which was the original adjusted cost base, and again, we're plowing back. Though that income is not being distributed, it's simply being allocated. So the new adjusted cost base now is $303,500. And the guaranteed withdrawal amount in this particular example, again, is $12,000. Again, what's happening here is there's going to be a capital gain on the redemption of units. That's going to trigger about $438 of capital gains. A proportionate share of units had to be surrendered to generate that $12,000 of income. Cash flow, I should say. The taxable capital gain will be 50% of the $1,500 of realized capital gains because there was some holdings sold, plus the $438 of capital gains that reflected the surrender of some units. So that's going to be a total of $969. Tax at 30% is going to be $291 of income tax. The dividends will also get taxed, and after the dividend tax credit will generate about another $180 worth of income taxes. So the net cash flow in that particular situation will be $12,000 minus the $291 of taxes owed on the capital gains and the $180 of taxes owed on the dividends. So the client still walks away with $11,529. In case study number 3, let's consider what happens if, with a guaranteed withdrawal benefit plan, if for that particular year there were $2,000 of Canadian eligible dividends declared and $1,500 of allocated segregated fund losses. So the fund may in fact have made money, but the fund manager looked at their holdings and said, you know what, that particular holding isn't doing particularly well. It may in fact be dropping further in value. So they decided to sell that particular holding at a loss and then reinvest the balance in according to the principles and direction of that particular fund. Again, fund allocates the segregated fund losses to all unit holders throughout the year. It's reported to the unit holder annually, and the cash flow from the guaranteed withdrawal benefit plan is achieved by redeeming or selling units. Again, operating like a systematic withdrawal plan. So the growth still is 5%. So the client's going to get a statement saying, you know, your starting balance is $300,000 at the end of the previous year, and at the end of 2016 or 2017 or whatever year we're talking about, your fund value now is $315,000. In this particular year, there was an annual fund income allocation of current eligible dividends of $2,000 and an allocated segregated fund losses of $1,500, representing an income allocation of $500. Withdrawal again is the same $12,000. So the capital gain on the redemption of units is a proportionate redemption of the capital gain of that 5%. But there was a net capital loss as well, which is 50% of that $1,500. And when you actually look at the total loss, because the capital loss is bigger than the capital gain, there still is an overall capital loss of $474. Which the client can use that particular year or in the previous 3 years or carry forward. And of course, it's still going to be taxed on the dividends after the dividend tax credit of of $180. So the client is still going to look pretty good in terms of the net cash flow in that particular situation. So the client's tax slip, again, will report eligible dividends, the taxable amount of the eligible dividends, the dividend tax credit on those eligible dividends, capital gains, and in the case of insurance segregated funds, whether we're dealing with a regular segregated fund or dealing with a guaranteed withdrawal benefit plan, will also report net capital losses. Now, what happens if you're dealing with a guaranteed withdrawal benefit plan and the market value of the fund class units drops to zero?
Peter, before you go on, we have a request for the handout for the examples that you've been sharing in these last 3 examples. Are you able to provide those?
Yes, Jeff. In fact, we can do 2 things. Again, as was shared at the very beginning of the session, for those that would like a electronic handout of the slides, we can certainly do that. Just talk to your investment wholesaler about that, or talk to your inside investment account representative. But if you go to the Empire website, to the advisor section, to investments, and to products, and you tick on class 2.1, you will see an article there called the Taxation of Class Plus 2.1, and those 3 examples will be actually sitting in the printout. So just go to the website and print it off, use it for yourself, or you know what, it's designed to be shared with clients. So if your clients have a problem understanding how this works, then by all means share that with your clients.
Thank you, Peter.
Okay. Again, you're looking at the guaranteed income phase, and the market value of those funds is zero now. I mean, you've drained all the money out of the contract, and maybe the fund hasn't done particularly well in the last couple of years, or the fund simply hasn't done as well as the amount of money you're taking out of it. But the income base for the lifetime withdrawal amount is positive. Then people have said, well, how is that actually going to be taxed from there on in? Well, the taxation is uncertain from a Revenue Canada perspective. You see, when they looked at all the rules and when they issued all the letters about how to treat top-ups and guarantees, the Canada Revenue Agency never contemplated an ongoing cash flow representing the guarantee. They're simply looking at a one-time top-up in most cases. So they're really not sure what's going to be happening. So typically what will happen, including what Empire Life will do, is that we'll report the payment based on the understanding of the legislation and the Canada Revenue Agency assessing practices at the time of payment. Now currently when you're looking at a top-up, a single top-up would be reported as a capital gain, and that's covered off in the Income Tax Act. But the ongoing payments, again, we're not sure right now, but of course, nobody in the industry has got clients that are sitting in that particular type of situation. So we certainly are applying continued pressure on the Canada Revenue Agency and the Department of Finance to clarify that particular point. And what we're very, very clear on, and all the documentation that we have, and what advisors need to be very clear on with the clients, is that the policyholder is going to be responsible for any tax liabilities arising from any change in law, interpretation, or Canada Revenue Agency assessing practice. So even if the rule was one way today, it could be very different in 10 years down the road. So you've always got to look at the law at the time that you actually look at taking out that income to figure out what your tax position is going to be on that particular contract. And as a sideline note on that, of course, we know that the budget is going to be coming out this particular year, and there was scuttlebutt about what may be happening to the inclusion rate for capital gains. So you know what, in this particular example, I'm using 50% as an inclusion rate. That law could change. Those rules could change, next week or the week after that. That could happen. And then, of course, the change would have to be made to your marketing practices and to any examples that we actually used or you used in explaining how this worked with clients. So Jeff had asked earlier, based on a question that came out in one of the lines, do we have an overview of the tax treatment of withdrawals that came out of our guaranteed withdrawal benefit plan? Here's an image of what that actually looks like. Again, go to the advisor section of the website. Look up Class Plus 2.1 and look at the tax treatment of withdrawals from a Class Plus 2.1, and you'll get those 3 examples I just talked about. Earlier, Jeff, one of the listeners asked about this calculator we've got. Again, if you go to Empire Life Investments and you go to Resources, which is highlighted in this particular image, this is a screenshot of that, and you look at the Series 2 calculator, you can very, very simply input these particular numbers in terms of your investments, your pre-tax cash flow, how much money you expect to get as a rate of return, where you're living, your marginal tax rate, and your annual distributions. And basically on that, the Series T calculator will calculate the cash flow from a Series T plan, payout plan, and also do a comparison using those same assumptions, using a systematic withdrawal plan, or using a GIC. Let's now look at the investments in the capital dividend account. What happens if these investments are actually held, we're talking about, in a corporation? And I'll do most of this schematically. So your clients may, the money that you're looking at investing, or the clients' money that's being invested, could in fact be sitting in a holding company or an investment company or a management company. And those represent assets and earnings that are held in cash and plus retained earnings. If that money is going to come out of that investment company or out of the holding company, it's going to be paid out as a taxable dividend to the shareholder, but on occasion, some of it could be paid out tax-free if it's actually declared and qualifies as a capital dividend to shareholders. And capital dividends, of course, are tax-free. Let's focus on that latter example here. So every corporation, private corporation in Canada, so a Canadian-controlled private corporation, has a notional capital dividend account. It's just a tracking system to keep track of monies coming in and monies coming out of that plan. Life insurance proceeds, net of the adjusted cost basis of the policy, immediately before death, the net amount goes into that notional capital dividend account. And any of you that are licensed to sell life insurance know about all the changes that have been made in terms of how much of credit goes into those policies effective 2017. The untaxed portion of eligible capital property owned by a business also gets credit of that capital dividend account. So too are capital dividends that come from other corporations. The non-taxable portion of capital gains from a trust that's distributed to a corporate beneficiary also goes into that account. And this is a situation where perhaps we've got a trust that's that's set up in a company that perhaps has gone through an estate freeze of some kind. They set up some type of family trust, and there's non-taxable capital gains, non-taxable portion of capital gains are triggered. People say, well, I know what happens to the capital gains. They get taxed. What happens to the non-taxable portion of the capital gain? Well, they go to that notional capital dividend account, and of course the directors can declare a capital dividend, and provided there's a positive balance in that account, they can be paid out tax-free to the shareholders. The excess of the non-taxable portion of capital gains over non-deductible capital losses also gets credited to the capital dividend account. And that money, if there's a positive balance, can be paid out tax-free in the form of capital dividends to shareholders. Now, just pay it out and let it go at that. No, there is some paperwork that needs to be achieved, that needs to be completed by the shareholders or by the board in order to actually make that actually happen. Let's focus on the excess of the non-taxable portion of the capital gains over non-deductible capital losses. So in period one, your client buys a segregated fund, or they buy a mutual fund. But they buy it with corporate assets. So in fact, the corporation is the owner of that segregated fund or that mutual fund. So they buy it in the year one for $100. And in year two, they decide to sell it. In year two, or period two, they decide to sell it. That asset has now doubled in value. That particular investment is now worth twice as much as it was when the client bought that plan. So there's a realized capital gain there of $100. Half of that will be taxable. The other half will get credited to the capital dividend account. The company then would file an election for a capital dividend under the Income Tax Act with the Canada Revenue Agency. They attach a dividend resolution to the form, which simply states we're going to be declaring a dividend. We're going to declare that as a capital dividend, and by filing that form, making that election, they can then write themselves checks out of that capital dividend account. If the shareholders have little other income, maybe they should consider paying some taxable dividends. Accountants will frequently say, maybe do that. It may trigger little or no tax, but remember as well that most of these corporations that have got passive investments in them may also have refundable dividend tax on hand. So they've been earning dividends on those investments and other issues. They've got taxes they paid on that plan, and to the extent they eventually pay those investments out or that amount out, they can recoup some of that. And that may increase the cash flow when you're looking at simply capital dividends by themselves. So the client may, in fact, get better cash flow, more cash flow by doing that.
Again, Peter, before we go on,
yes.
Just a quick question. Just to confirm, can you confirm that the capital dividend account can be used for segregated funds as well as mutual funds?
Yes, yes. There are people that sometimes say, well, geez, you know, I've got a mutual fund, and the only reason I recommend mutual funds to a client who's got the investment sitting in a corporation is that I get this big tax break. Well, that's true for mutual funds. It's also true for mutual fund corporations. It's also true for segregated funds. So it doesn't matter. It would also apply to a stock holding. It matters little what actually happens. So yes, the answer, yes is the answer to the question about segregated funds. And that could be an advantage with Empire's funds when we have the opportunity to invest in a very, very high equity component. So depending on the risk profile of the individual and that money sitting in the corporation, very, very high equity component, and that fund performs very, very well, then 50% of that gain, the increase in value, can be triggered to go into the capital dividend account, and provided there's a positive balance in that account, be flowed out to the shareholders tax-free. So I wrote 2 articles on this, on the capital dividend account, how it works, and this is covered off in an article I did on initiative a few years back, plus another article I did on the capital dividend account and investments, which speak specifically to what I just said right now. Those 2 articles are available on the advisor section of the website. Simply go to the advisor section of the website, go to business building as the tab. Underneath of that, go to tax and estate planning. We've written a number of articles over the years. There's a library of newsletters there, and you'll find those 2 newsletters in there. So look for it on your own. If you have any type of problems finding it, please speak to somebody at Empire Life, and we'll be glad to get those forms out to you so that you can educate yourself, refer to these documents for reference purposes when you get questions about how the capital dividend account works with respect to investments, and you may want to share that as well with either your other professional advisors or with select clients. So I reviewed a number of things today. We've explained the reporting and taxation of growth, income, and cash flow out of the investment funds. Hopefully, you've gained a clear understanding of the differences in reporting between segregated funds and mutual funds, both during the accumulation period and for payout plans. And you've also learned how they work in both individually owned and corporate-owned scenarios through the use of case studies. We addressed the question of the reporting of capital distributions, including a section on the capital dividend account for Canadian-controlled private corporations, which may be used to distribute certain types of investment income. But we did exclude company and shareholder taxation of that passive income because that would be the subject of another session. You will undoubtedly meet clients at the converging roads of assessing investment returns for the year and figuring out their tax slips on those same investments this year. It happens every year around this point in time. Hopefully your journey of discovery today with me provided some clarity and understanding of how fund earnings are reported for income tax purposes. Good luck and good marketing. Jeff, I return it to you.
Thank you very much, Peter. So I want to thank everybody for logging into today's Empire Life webinar, Understanding Taxation of Funds. For those of you who have logged in the entire time and are logged in individually, you will be issued the applicable CE credits based on your registration. And for those of you who joined late, or if you have friends or colleagues who would like to view this presentation later, check back with your account executive for the link to the webinar, which will be posted on the Empire Life website and which will be eligible for CE credits should you go through the entire process, the pre-recorded webinar at a later date. We will also be able to issue CE credits for that as well. So again, thank you everyone for participating in today's webinar. We hope you found it both insightful and informative and helps you in your day-to-day dealings with your clients. So again, thank you very much for participating in this Empire Life webinar, and we'll have a great day.